All right. Good morning. Literally, good morning. It's 4 a.m. in Singapore. Good afternoon, good evening, wherever you are. We are ready today for really earnings season to officially kick off. We have Tesla, we have Google, we have ServiceNow. I believe all of them are today. Is there anybody else? I think IBM as well. IBM, let me see. Who else is releasing their earnings right now? We have Google, we have Tesla, GE Veranova. Okay, interesting. Texas Instruments. So we know IBM. Good morning, Kunal. Good morning. Good morning, Harpreet. Yes, I no, I'm not up late. I've been awake. I took a nap before my earlier stream. Went to the gym and then I'm back here. We have GE Veranova. We do have IBM and uh, good afternoon, Kevin. Yes, and that is going to change, Harpreet, this time around. I will be live for most of the market close earnings. Yeah, because I'm more or less settled into my new workplace. I have a system that works, so I don't always have to be in office right now. And yeah, that allows me to be live all the time for the entire earnings season. All right. To answer your question about now, I went to look into Pegasus systems because they were the one that caused the whole crash. I was just saying on my morning stream that on night stream, whatever it is, the market open, that I wasn't exactly sure why was ServiceNow down by so much. And basically, I shared this because I happened to see this. Where was it? So this account, Wall Street Engine, I'm sure most of you would know, they actually reported Pegasus earnings, and Pegasus. To be honest, I really never. Uh, no, not Pegasus. Sorry, why do I keep calling Pegasus? Pega Systems. I've never really heard of them before, so I can't say I'm familiar with what they do. But a little bit of Claude uh, told me that basically they're a 40-year-old company that runs a lot of backend for insurers and financial institutions. Let me pull it up. Yeah, I mean I didn't sell my position because it's only a small position uh at the moment. And I do have a covered call on it. So it just means my covered calls are printing. Wait, I Claude this. Let me see. Where is my Pega systems? Okay, so what Pega systems do is they actually sell workflow automation, and this is the category that I mean, I guess AI agents are threatening to replace. So, from what I understand, uh, they are a 40-year-old company that really runs a lot of the back end for banks and insurers. Let me see. Yep. Okay, their software like lets big banks and insurers build out automated business processes. For example, if a customer disputes a credit card charge, here are 12 steps that happen next. So they build that kind of workflow automation. And these are things that can be very easily replaced by AI agents. And I think that is why customers are delaying spending from Pega systems. So this you couple in together with whatever that is happening with IBM, uh, I think that it gives a totally different problem altogether because from what I understand, in IBM's case, yes, consulting side of the business actually slowed down. So we didn't. Oh, okay. We actually did not. The consulting side of the business slowed down. So that was why revenues fell. Of course, the software side of the business, OpenShift AI is not really the go-to. I believe they use Kubernetes, which is a open sourced software. So that is so I feel like it is completely different. Like IBM's scenario is a bit different from Pega Systems. Pega Systems also is different from ServiceNow because ServiceNow is the orchestration layer of the entire AI engine. All right. Right now, let's see whether we have the earnings come out. Let's see. Let's see. Let me. Have they released their Q2 earnings? Q2 earnings are not out. Oh, they are. Okay, let's take a look. Earnings release. This is for Google, and then we also have. Do we have it for Tesla? Oh, this production and delivery. Okay, we are still waiting on Tesla. Let's take a look at Google first. You know, I'm still figuring this out. I subscribe to like Bloomberg and CNBC. I'm just not sure whether I can. I'm not sure how I can actually share the streams. I believe like when I share the streams of CNBC and Bloomberg, gets my channel muted. So let's take a look at their earnings. Okay, second quarter results. Revenues increased 24%. Wow. If search grew 17%, that is good because the entire search market tends to grow at around 12 to 13%. 24%, 23% in constant currency, 100 and nearly 100. This is basically $120 billion. Google services revenues, let's see, this is increased by 15%. We have 24% over here. Google Cloud, oh my goodness. Google Cloud saw its revenue increased by 82%. Last time around, we did what, 64%? 82% is insane. How much is the Googs up today? Let's see. Let's go. What's the okay? Google. Where's Google? Oh my goodness. So Google is down. Oh my goodness. They're down. Why are they down? Tesla is down. Tesla is down 3%. You see, I mean, at the end of the day, I don't really mind search growing at 17 or 19%. To me, it's not a problem for the very simple reason. The search market is growing at what, 12%, if I'm not mistaken. So it depends on where you are taking this from. Uh, we are basically expecting search growth of around 11 to 12%. That's the number that I tend to remember, and this is what I'm seeing over here. So if you are expecting search to have a CAGR of around 11% and Google is growing at 17, 19%, it shows that they're actually taking market share. So I am not too worried about that. Let's go on and take a look at the rest of their earnings, and then we can see what the market is pissy about. Uh, Well, I mean, it's down now just 0.5%. Okay, let's continue to look at this. Operating income increased 30%, margin expanded by 2% to 34%. All right. In my initial projections, I was thinking 32%. This is good. Net gain of $89 billion. Yeah. They did say result of net unrealized gains. So we have to take that out of the equation when we do our valuation for them. So net income increased by this, and of course, EPS then increased to $9.11. Later, we'll take a look at the actual numbers. Google search over here, this is strong. This is what I think Kunal was talking about. So I think you like to see this, right? Up 17%. YouTube ads, this is up over 20% over here. Fantastic. Google network, more or less the same. So advertising is up over 10%. Fantastic. Google subscriptions, platforms, and all of those things together. Services up around 10 or also 10 plus percent. So Google Cloud is where you get the real growth over here. This is the key growth driver for Google Cloud. And we are seeing, I mean, $24 billion is fantastic. Total revenues, $120 billion. Number of employees, okay. operating income. And so you can see cloud over here. If you take $8.8 billion, divide this by 24, it's like what, 30% margins at least? 8814 divided by 24,768. That's 35% operating margins for Google Cloud. So like I said, this is more or less where I expect them to be, because Amazon tends to operate at around 40% margins for AWS. So Google Cloud 35% margins, I think, is more or less within that ballpark. All right. Let's continue to take a look at the numbers over here. This was the equity raise that we spoke about. The net proceeds of 50 billion used for general corporate purpose, capital expenditures to scale AI. Okay, so we know at least $50 billion. Adding equity distribution with certain agencies up to 40 billion. So total about $89 billion raised. The proceeds, I thought it was 80 billion. So it's $89 billion. Okay. Are primarily intended to meet tax obligations. Okay. That's fine. Quarterly dividend of 12.15. All right. I mean, Google is not down much. It's basically flat on the day. We ended the day at 341. We are at 340 right now. So it's basically flat on the day. Okay, let's take a look at the. Let's take a look. So I'm interested to hear management's commentary later on around the delay over Gemini 3.5, because you can see there are observable difference between Gemini and what Claude and ChatGPT are doing right now. So I will be keying this into my spreadsheet in a bit. Yeah. Later on, we will be filling this up. Okay, later on. Let's take a look at let's finish looking at this first. Okay, so I mean this is a good breakdown. Alphabet revenue 24%, search 17%, Google Cloud 82%, tokens per minute. Wow. Tokens per minute has really increased since last quarter. YouTube up 13%, and Gemini monthly active users nearly 1 billion people on Gemini. Fantastic. And I'm interested to know whether or not this monthly active users, how do they actually get to this number? Because are they counting it as, whenever Gemini pops up on my Gmail and I click on it, is that considered a Gemini user, or must you actually use the interface itself? It's interesting to see how they count that. Basically income statement over here, nothing much. All right, so Alphabet revenues, 34% operating margins, fantastic. 24% year-over-year growth. So in general, I think although operating expenses grew by 27%, a lot of that is into R&D. Like R&D, there's nearly a 30% growth. More than that. Is that 30, 40%? It's like a 38% growth in R&D spend. I think SG&A basically stayed the same in terms of a percentage value. That's 7% for Yeah. Yeah, so I think SG&A basically stayed the same. We see R&D basically up 30%. I think that's only natural, seeing that they're in this AI race at the moment. And so this is basically how the revenue is being broken down. Okay, that's interesting. Let me just divide this. 5209 plus 7101. You basically last year you had around $12.3 billion of of SG&A. This quarter, you are basically at 14.8 billion. So if you take 14.8 billion divided by 94.5, you are basically at 15% over here. This is 15%. And 12.3 divided by 82.54, you're also at 15%. So you can see their SG&A basically stayed constant. They actually spend around 15% of overall revenues on SG&A, and the majority of it has gone into R&D increase. That's why you can see the expenses increased. And I think that's what you want to see, right? You want to see the companies that you are invested in constantly reinvest back into the business, constantly developing new businesses, and that's where R&D comes in. Okay, Google Cloud, this is insane. 82% year over year after growing 32% last year, and I think what 64% in the previous quarter. This growth here is absolutely insane. I think this is exactly what we want to see. And operating income, you can see this sudden shoot up in operating income, basically grown by what, nearly 3x during this time over the last 4 quarters. CapEx basically expected to be. Oh, okay. This is capital expenditures. All right. Trailing 12 months free cash flow, 53,273 divided by 94. That is sick. That is on a trailing 12 months basis. Their free cash flow. Oh, sorry, I'm dividing it by the wrong number. Oh, is this why they are? Oh, their free cash flow this time around is negative. Is this why they are a little bit? People are a little bit pissy. Oh well, I guess people are not pissy anymore. They're up 0.5%. Tesla is still down 3%. We'll get to Tesla in a little bit, but good to see. Well, I can't even remember the last time I saw Alphabet free cash flow negative. Oops. Can you hear that? I was watching some Pokemon stuff and then it just popped up when I was clicking on the tabs. All right. Let's go. Yep, 80% growth due to its capex spend. Yep, I think it's only natural, but I think up 0.5%. I think it's more than I could have asked for. I mean, seeing that it was down what 1.5% earlier on, it's quite a decent recovery. Do we have anything else? So I think in general, Alphabet's Alphabet had quite a decent earnings. Like there's nothing that stands out to me over here. The earnings call is at like 1:30 p.m. Pacific time. So what time is that in Singapore time? 1:30 p.m. to Singapore time. 4:30. So we have Alphabet's earnings call in about 10 minutes. All right, let's very quickly jump. Oh, let's see what has happened to ServiceNow. You know what? Seeing that my portfolio value is still at 118,000, I think ServiceNow hasn't completely fallen off the cliff. Where is ServiceNow? ServiceNow. Oh my goodness, where's ServiceNow? Am I blind? Oh, look at that. Up 8%. Exactly what I was saying earlier on. The software story between IBM, Pegasystems, and ServiceNow is completely different. Thankfully, I decided to jump on 5 minutes uh, before the earnings release so that I could get that out there because I know people were worried about it. Today, I was confused why ServiceNow was down 6%. We basically made everything back. And I think the argument over here, people look at it and say software is dead or software is being replaced. People are slowing down their spend on software. People are slowing down their spend on unnecessary software. So in IBM's case, uh, what we are seeing is that people were buying their hardware, but because the OpenShift AI is not one of the go-to softwares to run your entire tech stack, people usually go through Kubernetes, if I'm not mistaken, the one that CoreWeave uses, right? Let me see. So Kubernetes, if I'm not wrong, yes, because like I said, recently I've been trying to like piece together the entire uh, AI tech stack and software ecosystem to understand where the value propositions are at each layer. And what I realized is that Kubernetes is used by nearly everybody, so anyone can use it. And companies like CoreWeave, they do sell their own version of it. Uh, yeah, and I think for IBM with Red Hats, the enterprise layer for Linux, if I'm not mistaken. I'm not too sure whether or not that is as popular as Kubernetes because Kubernetes seems to be used by everybody else. So I have to do a little bit of digging, but for me, initially when I looked at it, I just didn't feel like, oh, it made a lot of sense because if everybody is running on Kubernetes and you are running on Linux or whatever Red Hat is, OpenShift, it made sense that people held off on purchasing more OpenShift if they felt like Kubernetes was a better fit for their use cases. Secondly, when it came to Pegasystems, the kind of automations that Pegasystems do, those are the things that the AI agents will replace in time. But as Jensen Huang himself has already said, ServiceNow is not just a services platform anymore. They are an orchestration platform. All the agents work within the framework that ServiceNow allows it to work within. And so that's how companies can deploy the agents at scale within the enterprise layer. But I'll hold off on ServiceNow for a little bit. I feel so justified by this. I know people were freaking out about ServiceNow after the drop this morning and after IBM, but I feel that this is so justified. I think it really proves the thesis that there are different layers in terms of software, and there are different layers in terms of the importance of software to a company. So you can see companies like Zeta, now it's up 1%, maybe because of ServiceNow. Basically, I think ServiceNow saved the entire SaaS market. All right, let's take a look at Tesla's disclosure. Okay, we have the slide deck over here. All right. I have to say I don't follow Tesla extremely closely. Uh, because I've always found it a little bit too pricey. I missed, yeah, like Tesla just was one of those companies that blew past my price, and then I like the company, never ever got around to owning it because in the end I ended up buying things like Palantir and SoFi and all that. So I just didn't uh I didn't really get to own Tesla. I think I might have bought it at some point for a while, like a trade or something like that, but nothing substantial. Let's take a look. Okay, so let's see. Oh yeah, Palantir on pullbacks. How much is Palantir? You see, a lot of the software names are like rebounding. A lot of the Palantir down 6% today. I think it's a good place to add. We are still under the 50-day moving average. We are under the 200-day moving average. Waiting for a little bit of support to form. Yeah, there were really a lot of opportunities to add today to the software names. We'll take a look at that later. Let me just go through the Tesla numbers before we actually get into the call. We are at Q2 2026. So we have 23. Oh, you know what? I don't have Tesla numbers at the back of my head like Google. So where is Fiscal AI? Fiscal AI is fantastic for things like this. Tesla financials, turn this to quarterly, all the way here. All right. So Tesla's revenue. Oh, wow. Okay, that's quite a bit. Like Tesla's revenue growth has been rather lumpy. So from what I'm seeing over here, you can see since September of 23, 8%, 3.5%, then decelerating growth, negative 8.7, 2.3%, 7.8, 2.1, negative 9, negative 11, 11, negative 3. Last quarter, we got 16%. And I think this quarter, it's telling that we are getting 23% growth. That's what I'm seeing. So initial impressions is that okay, maybe the Elon being a political figure factor is starting to wear off a little bit. I think that's what we want to see. Let me get in a comfortable position since we're going to be here for a long while. So that is that's automotive revenue. Okay, so total revenue, yeah, total revenue is up 26%. That's fantastic, right? Automotive up 23, energy generation 13, services and other revenue. I think this is going to be a big growth driver for them, services and other revenue. It's really a silent part of the business that people don't really talk about. 26% year over year growth, re-accelerating their growth rates, things you love to see in a business. Gross profit, margins compressed once again, not fantastic, to 16.8%. Let's listen to what management has to say around margins. But I think if they can operate consistently in the low 20% range, I think people should be happy with that. Yeah, you know what? I mean, the Chinese cars are everywhere in Singapore as well. And I think because like Singapore being a Asian country, people are a little bit less averse to Chinese cars. So I do have a couple of clients that swear by their Chinese cars. Dongfeng is a new brand that came in. They do produce some Chinese military vehicles, and then they have produced cars in Singapore. The financing options for the Chinese cars in Singapore are ridiculous as well. It's above and beyond what you can get for through a normal car dealership. So they are marketing quite aggressively in Singapore, but but I don't know. I will probably have to switch my car next year, and I'm still leaning towards getting a Tesla. But I have to say, the BYD is catching my interest. So we will see. Let's see. Operating margins 1.4%. Okay. So I think we saw revenues increase, but margins compressed this time around, right? Maybe that's why they're down 3%. Are they still down 3%? Yeah, they're still down 3%. Like Harpreet said, probably Elon will pump up the stock in the earnings call. I am not sure which call I'll listen to. It's about 1 minute away. I'm thinking I'm leaning towards listening to Google's call. I think that is more relevant to the AI space. Yeah. So this this entire quarter for Tesla is really a margin compression story. We just have to listen to management talk about why margin compress. Yeah, free cash flow has turned negative for Tesla, and cash and equivalents. I mean, they're still very well capitalized, so no issues over there, right? So, Model Y, Model 3 production up 12%. Other models, this is fine. Total production up 10%. Deliveries up 25%. So that's what you want to see. Cumulative deliveries to okay. Active FSD subscriptions. This is in millions, right? So 1.5 million. Yeah, but I think okay. So honestly, in Singapore, like the autonomous features are not fully enabled, I believe. So it really doesn't make much of a difference for me. It's more of a which car do you feel better driving? Yeah. You know what? To me, this is a little bit like brand loyalty. It's not like I have a Tesla right now, but I feel like Tesla is like one of those initial companies when I first started investing that I got really interested in. And I mean I like Elon, I like his vision. Eccentric, yes, but that's how you get to, catching rockets when everybody tells you you're crazy. And it feels yeah, to me it's like a vote to I don't really buy the stock, but I don't mind supporting his products. Oh, JCOOS is especially popular in Malaysia. I've started to see it come to Singapore. Yeah, but Singapore it's mostly BYDs and Xpeng. Yeah, Google negative free cash flow is crazy, but I think people are still okay with it, judging by the performance. The stock is still flat. It was up 0.5%. I think the call is now. Am I right? Is the call now? I never thought I would see Google negative free cash flow, but you know what? We'll talk more about that in a bit. Let me mute myself. I'll put on the call. And then later on we will talk about ServiceNow and Tesla. But I am happy that my ServiceNow uh, expectations actually were true. People were freaking out over ServiceNow's, and my thesis is that there are different layers of software. People cannot just choose to stop spending on ServiceNow. All right. I'm going to be playing this.
Unless we state otherwise. And now, and cloud backlog grew to $514 billion. It's great to see the wide adoption of Gemini Enterprise with nearly 90% of Fortune 100 using it. Today, I'll expand on our AI progress, our global product footprint led by search and YouTube, Google Cloud's leadership, and our long-term bets. First, AI. Yesterday, we announced new models, Gemini 3.6 Flash and 3.5 Flash Lite, which are cost-effective and highly efficient. We are seeing tons of demand for our workhorse Gemini Flash series because it hits the sweet spot of performance and cost. We also launched Gemini 3.5 Flash Cyber, which I'm really excited about. Paired with our CodeMender agent, it finds and fixes vulnerabilities and delivers performance at the frontier, comparable to far bigger cyber models. Gemini 3.5 Pro is currently in testing, and our team is already building the next generation of models. We have started our most ambitious pre-training run yet for Gemini 4 and are excited by the progress we are seeing at the frontier. Demand for our models is translating to strong token usage across developers and enterprise customers, and we continue to be supply constrained, a sign of momentum and rapid adoption. More than 9 million developers are building each month with our models across our APIs and key developer products. Our model APIs are now processing approximately 22 billion tokens per minute. That's up from 16 billion just a quarter ago. Additionally, this quarter, we launched Omni. It allows users to create anything from any input, starting with video. Since launching at I/O in May, there's been a 40% increase in daily active users creating videos on the Gemini app. Our Gemma family of open models, small enough to run on local devices, are hugely popular. These models have been downloaded over 900 million times, and our latest Gemma 4 models have been downloaded over 300 million times since launching in April. Our agentic development platform, Antigravity, allows anyone to build in the agent-first era. It has more than 2.4 million weekly active users. Antigravity is a powerful tool for users and enterprises, and it's completely accelerated how we build internally. As just one example, a team in Chrome is now on track to accelerate delivery by 8 times, compressing a 2-year timeline into 3 months through model-driven refactoring. Moving on to our global product footprint, which brings AI to more people than any other company. Starting with search, AI continues to drive an expansionary moment, with new experiences resonating with users and driving growth in queries. As a big football fan, I was particularly excited to see search usage hit an all-time high during the World Cup this year. This really highlights how much people turn to Google in moments that matter. We continue to make search more helpful and intuitive. We recently brought together AI overviews and AI mode into one seamless search experience that combines our frontier capabilities with the best of the web. And we are continuing to incorporate more frontier capabilities into search with agents, personal intelligence, and notebooks. Our AI-powered features are driving increased search usage. Since expanding AI mode globally last October, we have surpassed 1 billion monthly active users. And just like AI overviews, AI mode is driving an incremental increase in search queries overall, and we are now sending billions of clicks to websites every week through AI features in search. As we serve more of these queries, we've continued to drive efficiencies. Thanks to our engineering and hardware optimizations, this quarter we reduced the cost of AI mode responses to its lowest level since launch, even as we have brought more advanced AI capabilities. Philip will also talk more about how we are innovating the ads experience. Next, the Gemini app, which now has 950 million monthly active users, with daily active users tripling in the last year. Users love new agentic features like Daily Brief and our personalized agent, Gemini Spark, which is now available in the US and internationally. We've been shipping helpful new features like this at an incredible clip. On to YouTube. Month after month, when a big event happens in the world turns to YouTube. It's been incredible to see that over 1.7 billion unique viewers globally watched World Cup-related videos on YouTube during the FIFA World Cup 2026. We're also bringing the power of conversational AI directly into the YouTube experience. Ask YouTube uses our Gemini models to let people ask complex questions about individual videos, get quick takeaways, and jump straight to moments in those videos. The early engagement is encouraging. More than 140 million users engaged with Ask YouTube on the watch page in June 2026. And we are bringing that Ask experience to the wider search experience on YouTube. Next, cloud. Our continued momentum is driven by our integrated AI portfolio consisting of chips, models, data, security, and agent platforms, all designed to work together. Gemini continues to be a key driver of growth and is deeply integrated across all of our cloud products, including Gemini Enterprise, data analytics, cybersecurity, and Google Workspace. We are seeing strong, diversified demand across products, customers, geographies, and industries. Our product differentiation is driving expansion in 3 ways. We are winning new customers, more than doubling our acquisition velocity year over year. We are deepening our relationships with existing customers who are expanding their usage and exceeding their commitments by more than 50%. Also, an acceleration over last quarter. We are driving growth with partners, with transactions on Google Cloud Marketplace growing over 7 times year over year. One of the strongest parts of our growth comes from the rapid adoption of our Gemini Enterprise platform. It's differentiated with easy-to-use tools to build agents and automate processes, connectivity to enterprise systems, cost management, and governance tools. In Q2, Agent Development Kit, our framework for building and deploying enterprise AI agents, reached nearly 70 million total downloads. As I said, nearly 90% of Fortune 100 are using Gemini Enterprise. We have customers like PepsiCo for AI and analytics solutions, Intel to streamline core processes, HSBC for wealth management, Bell Canada for customer engagement, Macy's for commerce experiences, and Signal Iduna for knowledge management. More broadly, Gemini is transforming how millions of businesses use AI to build custom agents, automate processes, improve cybersecurity, manage customer relationships, streamline data analytics, collaborate effectively, and more. All of this momentum is driving growth in our paid token usage. Nearly 500 cloud customers have each processed more than 1 trillion tokens in the last year, and usage is so much deeper than that. Over the last 12 months, more than 2,000 enterprises consumed over 100 billion tokens. We're also seeing strong interest in our AI-powered security platform, which is differentiated because it integrates threat intelligence, cyber response prioritization with WIS, AI automated scanning, code remediation, and monitoring. Today, 90% of Fortune 100 are Google Cloud security users. Nearly 90% of WIS customers are using AI-powered security features. And we have seen a more than 45% quarter-over-quarter increase in the number of AI workloads scanned and protected by our security platform. Our security tools are being used to protect critical infrastructure, including financial services organizations such as Morgan Stanley, telecommunication providers such as TELUS, healthcare organizations such as Texas Children's, software companies such as Atlassian, and several government agencies. And with our new Google AI Threat Defense, we are really excited to bring our new cyber model and code mender to help our customers defend against AI threats. All of this is powered by our leading AI infrastructure. We offer the industry's broadest range of accelerators from Google and NVIDIA, including the new NVIDIA Vera Rubin platform and TPU 8T and 8i, which delivers strong price performance. On top of this, let me mention 3 unique offerings. First, our Virgo network, which is designed to meet the needs of modern large-scale AI workloads. It allows customers to connect 1 million AI accelerators across multiple data center sites into a unified supercomputer. Second, our software stack has native support for JAX, PyTorch, VLLM, and SGLang, enabling workload portability across GPUs and TPUs. And third, our new agent-optimized Axion CPU provides 30% better performance per dollar compared to peer offerings. We are seeing strong growth in demand for our AI infrastructure offerings from leading labs such as Ineffable Intelligence, next-generation AI builders, including Kakao, financial services like Deutsche Börse Group, pharmaceutical companies such as Pfizer and Roche, and robotics and spatial intelligence companies such as World Labs. We are continuing our strategy of investing in promising companies and internal efforts that bring pioneering AI research into the real world. We have seen exciting progress from our other bets. Waymo introduced its newest vehicle, Ohio, to public riders. This is the first vehicle powered by the 6th-generation Waymo driver and will welcome more riders in the coming months. Wing has safely completed more than 1 million home deliveries, and we continue to grow our presence through partnerships with Walmart, DoorDash, and Papa John's. In health and drug discovery, Isomorphic Labs raised over $2 billion to power its AI drug design engine, scale globally, and advance its drug candidate pipeline. It's truly been an extraordinary first half of 2026, with much more to come. Thanks to all of our employees and partners worldwide for their incredible work this quarter. With that, Philip, over to you.
Thanks, Sundar, and hello, everyone. I'll start with a review of Google services, highlighting our momentum across search, YouTube, and partnerships. Google services revenues were $95 billion for the quarter, up 15% year-on-year, primarily driven by search. Search and other delivered 17% growth, with retail and finance driving the largest contributions. YouTube advertising revenues grew 13%, driven by direct response and brand. Network advertising revenues were down 1% year-on-year. Strong performance in search and YouTube underscores how our investments in AI translate into measurable value for our users and advertisers. Starting with search and other. Revenues reached over 63 billion for the quarter. Sundar highlighted the momentum we see in search, which directly impacts our advertising business. We continue to accelerate the deployment of Gemini across our entire ads infrastructure to boost performance in 3 areas mentioned before: ads quality, advertiser tools, and AI user experiences. First, ads quality. At Google Marketing Live, we showcased how Gemini improves query understanding, allowing us to find relevant ads for longer searches previously difficult to monetize. The core engine of our search ads relies on a dual prediction, delivering immediate utility for the user while maximizing measurable value for the advertiser. Gemini completely supercharges this capability. We use Gemini's advanced reasoning to decode the nuances of longer, more detailed queries. With shopping ads, for instance, we drove a 20% improvement in showing highly relevant ads, helping shoppers immediately find the best match. Second, advertiser tools. Take AI Max. It has become the core building block for advertisers to fully participate in our new AI experiences. It's out of beta, and 500,000 advertisers have already adopted it. Those who adopt our AI-powered campaigns like AI Max or PMax see an average of 15% more conversions or value on search at a similar ROAS. AAA Auto Club enterprises used AI Max to personalize creative assets and capture growth from increasingly detailed insurance searches. This led to a 17% improvement in conversion volume and an 11% decrease in cost per lead. We see strong adoption of our generative AI creative tools, which makes creative development easier, especially for SMBs. In fact, over half of our SMB customers globally use AI to create or optimize their creatives. Third, new AI user experiences. At I/O, we showed how search, including AI overviews and AI mode, works as one connected experience. As you saw from our results, our performance across this holistic system is robust. We continue to be encouraged with monetization performance on queries that show AI overviews, even as we've expanded AI overviews to more commercial queries. Across AI overviews and AI mode, people are asking more specific and detailed questions, providing opportunities for more relevant ads. Within AI mode, we continue to test and deploy a range of new ad formats. For text ads, we improved performance by adding contextual site links based on the conversation. Direct offers is gaining momentum with partners like IHG Hotels and Resorts soon surfacing special offers during trip planning. In highlighted answers, our latest experience, placing clearly marked sponsored links inside list responses, is showing early user traction. Looking at commerce. In collaboration with the retail industry, we established the Open Source Universal Commerce Protocol, UCP, as the new standard for agentic commerce. Merchants are rapidly adopting UCP, with Target and Steve Madden now live, while new members have joined the UCP Shopping and Food Tech Councils to help steer its vision. We also announced Universal Cart, allowing shoppers to add items from different retailers across Google services and buy in a single checkout. Now on to YouTube. As a FIFA preferred platform partner, we help fans around the world tune into the games. As Sundar mentioned, over 1.7 billion unique viewers watched World Cup-related videos, and over 550 million watched them on their televisions. This made the FIFA World Cup 2026 the most viewed World Cup in YouTube history. Advertisers connected with fans through FIFA channel takeovers, Gemini-powered soccer-themed sponsorships, and game day mastheads. And, of course, a huge congratulations to Spain for taking home the trophy. More broadly, on YouTube, we introduced an exclusive slate of creator shows, making it easier for brands to tap into the fandom of creators. We launched custom sponsorships to put brands at the heart of the world's biggest moments as they unfold on YouTube, using AI to dynamically surface videos tailored to a brand's desired moment. Brands continue to partner with YouTube creators to engage new audiences. Kate Spade reached Gen Z through a first-of-its-kind YouTube creator campaign and partnered with creators Ellie Thuman and Hannah Meloche. By leveraging multiple format videos on YouTube, the brand drove a 3.25% brand lift in purchase intent. This unique convergence of brand equity and commercial action makes YouTube a powerful full-funnel platform. SMBs continue to fuel our direct response growth through campaigns like Demand Gen. They leverage our AI to scale visual storytelling across YouTube, Shorts, and now Google Maps. To attract high-value shoppers across North America and Europe, outdoor brand Arc'teryx used Demand Gen to achieve a 70% better return on their ad spend compared to other paid channels. Looking at monetization across YouTube, we're driving sustained growth across our key priorities. In the living room, we see continued momentum across both brand and direct response. With the launch of Buy with Google Pay, viewers can complete purchases directly on their CTV, turning the TV screen into a stronger performance surface. Shorts continues to deliver high-performing opportunities for social and video buyers alike. Beyond advertising, YouTube subscription business, which thrives across living room screens, is growing faster than ads, particularly driven by YouTube Music and Premium. Internally, we leverage Gemini to transform how we work and how we serve our customers. 83% of our sales team uses Gemini-assisted tools weekly, driving up to a 20% higher win rate when using customized pitch narratives. Our ads customer support teams use Gemini-powered agentic solutions that now autonomously address 75% of support queries, freeing them to solve our customers' most complex challenges. Similarly, our new agentic solutions for SMBs have expanded our reach by hundreds of thousands of new customers year to date. As always, ending with partnerships. We're seeing more businesses benefit from the unified strength of Google's AI stack. Booking Holdings expanded a multi-year cloud commitment and are partnering closely to advance our AI-powered ad formats. It's also deploying Google's AI technology to enable new customer experiences like agentic dining reservations on OpenTable, helping restaurants get discovered and booked right when it matters most. In closing, I'd like to thank Googlers everywhere for their contributions to our success and our customers and partners for their continued trust. Anat, over to you.
Thank you, Philip. My comments will focus on year-over-year comparisons for the second quarter, unless I state otherwise. I will start with results at the Alphabet level and will then cover our segment's result. I'll end with some commentary on our outlook for the third quarter and full year 2026. We had an outstanding second quarter, delivering our 12th consecutive quarter of double-digit revenue growth. Consolidated revenues were $119.8 billion, up 24% or 23% in constant currency. Total cost of revenues was $45.9 billion, up 18%. Tech was $16.2 billion, up 10%. Other cost of revenues was $29.8 billion, up 22%, driven by increases in depreciation, inventory costs, primarily from the sales of TPU systems to customers, and content acquisition costs, largely for YouTube. Total operating expenses were up 27% to $33.1 billion. R&D expenses increased by 32%, driven by compensation from investments in AI talent, as well as depreciation. Sales and marketing expenses were up 18% due to investments to support the Gemini app and search and compensation. And G&A expenses increased 24%, primarily driven by compensation and charges for certain legal and other matters. Operating income increased 30% to $40.8 billion, and operating margin was 34%. Other income and expenses was $98 billion, representing a substantial increase from the prior year, primarily due to unrealized gains in our equities securities portfolio. Net income and earnings per share increased significantly, primarily due to the unrealized gains in OI&E I just mentioned. We generated strong operating cash flow of $39.1 billion in the second quarter and $185.7 billion for the trailing 12 months. CapEx was $44.9 billion in the second quarter, with the vast majority of the spend in technical infrastructure to support our investments in AI. Approximately 60% of our investment in technical infrastructure this quarter was in servers, and 40% was in data centers and networking equipment. We had negative free cash flow of $5.9 billion in the second quarter, driven by our investments in CapEx. Free cash flow was $53.3 billion for the trailing 12 months. We ended the quarter with $242.5 billion in cash and marketable securities, which includes $87.1 billion of marketable equity securities. Long-term debt was $98.2 billion. And as mentioned in our press release, our board of directors declared a quarterly cash dividend on our common stock of 22 cents per share, which is payable in September. Turning to segment results, Google Services revenues increased 15% to $94.5 billion, reflecting strong growth in search and subscriptions. Total advertising revenues were up 14%, with growth across all major verticals. We experienced strong ad growth related to the World Cup, particularly in YouTube ads. Google Search and other advertising revenues increased by 17% to $63.3 billion, with retail and finance driving the largest contributions. YouTube advertising revenues increased 13% to $11.1 billion, driven by direct response advertising, as well as brand, with strength in the living room, as Philip mentioned earlier. Network advertising revenues of $7.3 billion were down 1%. Subscription, platforms, and devices revenues increased 15% this quarter to $12.9 billion due to strong growth in both YouTube subscriptions, particularly YouTube Music and Premium, and Google One, which was driven by demand for AI plans. Google Services operating income increased 20% to $39.5 billion, and operating margin was 41.8%. The Google Cloud segment delivered outstanding results in the second quarter, driven by our enterprise AI products and services. Cloud revenues were up 82% to $24.8 billion, driven primarily by GCP, which grew faster than cloud overall. Core GCP, AI solutions, and AI infrastructure were all important drivers of growth. We also began to recognize revenues from TPU system sales, which we delivered to customer data centers for the first time in Q2. Cloud revenue growth accelerated meaningfully even after excluding the impact of TPU system sales. Cloud operating income was $8.8 billion, more than tripling year over year, and operating margin increased from 20.7% in the second quarter last year to 35.6%. Google Cloud's backlog increased by more than $50 billion sequentially, reaching $514 billion in the second quarter. The increase was driven by strong demand for our enterprise AI offerings. The majority of the backlog is related to typical GCP contracts from a broad mix of customers, and we expect to recognize just over 50% of the total backlog as revenue over the next 24 months. In other bets, revenues were $382 million, and operating loss was $1.8 billion as we continue to expand Waymo's business and invest in key other bets. And in Alphabet-level activities, the operating loss was $5.8 billion, driven by shared AI R&D expenses. Turning to our outlook and business performance expectations in the second half of 2026. First, in terms of revenues, at the current spot rates, we would expect a slight FX headwind to our consolidated revenue in Q3 compared to a 1 percentage point FX tailwind in Q2. This impact will be seen primarily in search and YouTube ads. In Google Services, as Philip mentioned, we continue to benefit from innovation in search by improving the user and advertiser experience with AI. At the same time, in Q3, we will begin lapping an acceleration in search performance that began in the third quarter last year. In Google Cloud, we're seeing significant demand for products and services, which we expect to drive strong growth. As I mentioned earlier, we started delivering TPU system to customer data centers in the second quarter. We continue to expect to recognize a relatively small portion of the revenues from our existing TPU system sales agreements this year, ramping as we exit 2026. We anticipate the vast majority of the revenues from these agreements will be realized in 2027. And given the supply-constrained environment, we plan to expand the use of third-party capacity in Q3 as a bridging strategy while we build out more internal capacity. This strategy allows us to keep growing our customer base and capture greater overall value. However, it will create modest margin pressure in the near term as we utilize this capacity. Moving to investments, we are updating our full year 2026 CapEx guidance range to $195 to $205 billion, up from our previous estimate of $180 to $190 billion. The increase in the range is primarily due to an acceleration in the delivery of capacity to meet growing demand. As we previously shared, we continue to expect our CapEx to increase significantly in 2027, and we'll provide more details at a later date. In terms of expenses, the
CapEx will
significant increase in our investments in
significantly in
technical
2027.
infrastructure
Wow.
will continue to put pressure on the P&L in the form of higher depreciation expense and related data center operations costs such as energy. We also expect to continue hiring in key investment areas such as AI and cloud. And we are investing in marketing to support our AI products. And finally, we expect the free cash flow will remain under pressure, driven by our investments in technical infrastructure, which enables us to capitalize on the AI opportunity and continue to drive attractive returns. Q2 represented another strong quarter. Our teams continue to deliver impressive innovation, executing with discipline and velocity. I want to take this opportunity to thank our employees for their contribution to our performance. Sundar, Philip, and I will now take your questions.
Thank you. As a reminder, to ask a question, you will need to press *1 on your telephone. To prevent any background noise, we ask that you please mute your line once your question has been
I
stated.
don't think I caught the RPO.
Our first question comes from Brian Nowak with Morgan Stanley. Your line is now open.
Thanks for taking my questions. I have two, one for Sundar, one for Anat. Sundar, with more time and Gen AI products and tools in the market and investment continuing to step up, can you just kind of give us some perspective on how your view on the size of the overall Gen AI ROIC opportunity and the timing of the ROIC has changed now versus 1 year ago? And then Anat, you talked quite a bit about supply capacity constraints. Maybe a similar question for you around forward CapEx. How is your budgeting philosophy and just constraints you're putting onto forward spend? How are those changing as you sort of think about the right amount to spend in 2027 to close this capacity constraint?
Look, thanks, Brian. I mean, it's a good question. I do think it feels like we are in very early innings of what feels like secular shift across multiple areas. In our core information businesses, just the possibilities when I see what all you can do with the absolute frontier capabilities, there's still a lot of work ahead to translate all that into experiences for our consumer users. You can think about end-to-end agentic experiences to really meaningfully do a lot more for them. So all of that looks like extraordinary opportunities with extraordinary returns for executing well on those opportunities. Similarly, on the enterprise side, as you can see from our demand, which is reflected in our growth rates, etc. Again, in my conversations with many CEOs, many companies, they're all still, barely scratching the early stages of what's possible here. So I think, we used to talk about cloud itself, very few, small percentage of overall workloads in enterprises have shifted to cloud. Now think about what percentage of workloads are really AI native and AI enabled. It again feels like very, very early. So I would say, from an ROIC standpoint, I think, we are taking a full stack approach. We are seeing momentum across consumers and enterprise and developers and so on. So it feels like, if anything, over the past year, we've gotten more bullish on the opportunities ahead. I'll turn it over to Anat.
Thanks for the question on how do we think about forward-looking CapEx in the context of supply constraints. So we're still in a supply constraint environment. I think we've said this now for multiple quarters in a row. And we are seeing very strong demand, both from external cloud customers as well as across the business. And our goal is to invest as long as we see an attractive return on that investment, as Sundar mentioned earlier. We do take a long-term view, so we take multi-year view at what the needs are, as well as focus on next year and the near term and building aggressively to meet those demands. And as you've seen, well, we have increased our capacity quite significantly over the past 3 years. The demand still outpaces that investment. And we are, just the rest of the industry, working in a supply-constrained environment. So we're working hard to do this. We do have a benefit of having the full stack approach. So we're able to drive operational efficiencies, technological efficiencies within our technical infrastructure organization so that we can deliver more compute. But as long as we see these attractive opportunities to invest, we will continue to invest.
Thank you both.
Our next question comes from Doug Anmuth with JP Morgan. Your line is now open.
Thanks for taking the questions. One for Sundar and one for Anat. Sundar, can you just talk about your confidence level that the Gemini models can remain at the frontier? I know you had the Flash model releases this week, but Google perhaps doesn't make maybe quite as much noise as some of the other leading labs, or perhaps have quite the frequency. Just curious how you'd address any concerns about that ability to continue developing leading models. And then just related, can you talk about your plans for coding and how you look to close the gap in that part of enterprise? And then Anat, just following the recent equity and debt raises, can you just help us understand how you think about optimal capital structure and how you view the cost of debt versus equity? Thanks.
Thanks, Doug. Look, I think the frontier is incredibly dynamic space, and it's fiercely moving forward. At any given moment when you take a snapshot, it feels dynamic. We've had clearly frontier models. There are many attributes on which we are still at the frontier. There are areas where we've acknowledged we need to improve. Coding and agentic coding is an example of that, and I think the teams are very, very focused on it. With 3.6 Flash, and by the way, Flash is our workhorse model, and we see tremendous demand for it, given it generally hits a sweet spot of performance, cost, reliability, latency, etc. And we've incorporated, Gemini and Flash particularly in our entire portfolio of solutions, be it in cybersecurity, data analytics. If you think about an area like customer service, you need really good voice quality, you need live streaming, you need the ability to reason on that. Or if you're a professional services firm, you need high quality summarization, content generation, etc. So, Flash does very well on all of that. In terms of agentic coding, we are iterating, and you will see us make continued iterations. 3.6 Flash, for example, compared to 3.5 Flash, jumped over, over 10 points in deep SWE as a benchmark, and it is more token efficient doing so. So we are clearly, we are using it internally. We are testing it with many customers in coding. So we see the progress just in 6 weeks from the prior version to the new version, and you will see more continued iterations on that as well. In terms of the frontier, we are both very committed and very confident of being at the frontier. For the next generation of frontier, you're going to need much larger base models. We are now training Gemini 4, and we're being very ambitious with it. I am very excited by the progress I'm seeing internally on Gemini 4, and I'm confident the people will be pleased when we are putting it outside. But we will need Gemini 4 as a larger base model to compete at that frontier level, and so we are focused on executing on that well.
And on the question regarding our capital structure and recent equity and debt raise, so as we think about our investment needs, and as I said, we look at the next year and multiple years out, we first look at how much we can support based on cash from operations. And as you've seen in our results today, we continue to generate very healthy, strong cash flow from operations. So that's our first source of funding. And then we look at debt, and most recently we did the equity raise. And we have expanded our debt portfolio quite significantly over the past 12 months. If you've seen a year ago, we were at about $16 billion, and we went to about $100 billion across multiple currencies and geographies. So we're expanding that portfolio. But we also want to make sure we have a resilient, not just growth outlook, but also a resilient balance sheet and a strong balance sheet, healthy balance sheet. which is the rationale behind expanding into the equity markets. At this point, we're not planning to go back to the equity markets, with the exception of, as you recall, part of our equity offering was the ATM or at the market offering that we will do to address the stock-based comp or the tax on SBC, which we'll do for some period of time. But we look at those three dimensions: the cash flow from operations, debt levels, and equity, in a way to balance it in a way that ensures that we continue to maintain a healthy balance sheet.
Thank you both.
Our next question comes from Eric Sheridan with Goldman Sachs. Your line is now open.
Thanks so much for taking the questions. Maybe two, if I could, both on TPUs. Sundar, can you talk about some of your key learnings as you scale your TPU efforts in terms of both the demand for TPUs and how you think about balancing the external demands for TPUs versus the internal demand for custom silicon inside the organization as you look over the next couple of years? And then, Anat, if I could just follow up, you made some comments in your prepared remarks about the impact of TPUs on Google Cloud. I didn't know if you could give us a little bit more granularity about the size of TPUs as a part of the revenue backlog and how to think about the revenue recognition or the potential for margin impact from TPUs in the years ahead. Thanks so much.
Okay, I think in terms of, first of all, we are very pleased with our TPU roadmap progress and the value in terms of performance, and the edge it gives, and we obviously use it extensively. In terms of allocating TPUs, look, our first priority is making sure we are allocating what we need to compete at the frontier in terms of AGI development, and so that is the foundation for everything we do. But given the extraordinary demand, to balance the external demand, even for most cloud customers, we are using both TPUs and GPUs mainly for serving our models. So think Vertex AI, Gemini Enterprise, the momentum we see. So we're using it or agentic workloads, etc. So we are using it for those purposes. To the extent people want it as infrastructure, we are balancing it by increasingly looking at opportunities to put TPUs in their data centers or in other data centers, like the project we are doing with Blackstone, etc. So we are using that as an ability to balance and make sure we are allocating as much of the available compute for frontier model development, as well as serving both our consumer business and our enterprise business in terms of first-party models.
And in terms of revenue recognition and how we look at the TPU system sales, so the way to think about it is the following. When we sign the agreements that I've mentioned in the prepared remarks, they would be then reflected in the cloud backlog. Now, the vast majority of the $514 billion of cloud backlog is the GCP agreements, but the TPU system sales are reflected in that backlog. We start building inventory to be able to sell those systems. So you see that impact on the cash from operations because we built ahead, obviously, as we're building that business and ramping up. And then once we start delivering the sales, generally, that's when we start recognizing revenue. This quarter was a small amount of the total, that total agreement. Will continue to ramp up throughout 2026, but then you'll see the vast majority of the revenue from that agreements come through in 2027.
Your next question comes from Ross Sandler with Barclays. Your line is now open.
Yeah, just back to the AI model kind of war that's going on, Sundar. Just want to ask about like the speed of model releases and how you can potentially speed up the cadence by which Gemini is releasing models. So we all saw the third-party compute deal with SpaceX. What else are we doing to kind of speed up the pace of model releases compared to some of the other folks out there? And then you just mentioned the flash models, which have been very successful, to your point. Do you view that as like the right end of the market to be in, given how crowded the lower cost end of the model space has become? Just any thoughts on how you see all that playing out?
Thanks, Ross. Look, I mean, two things I'll say. First of all, we really think about the Pareto frontier. We want to make sure for our customers, we are offering, best models at various price points, right? So, you will see us. But it's very important to us to have the best frontier models out there, as well as models which are very performant and low cost. This is why we have Flashlight, Flash, Pro, etc. And with so we are committed to being at the full Pareto frontier. On the speed of model releases, I do think you will see us continue to pick up pace. Obviously you've seen us come with we announced 3.5 Flash at I/O. We have followed that up with 3.6 Flash, and you'll see continued iterations of that model with further progress in agentic coding, etc. We are really focused, putting a lot of effort into Gemini 4. It's a very ambitious effort. We wanted to compete at the frontier level of where the frontier will be when Gemini 4 comes out. And so we are applying a lot of our compute and effort in that direction. But with that, we are creating a baseline on top of which you will see us rapidly iterate with subsequent model releases. And so, picking up pace and releasing models, almost at a monthly cadence is part of our roadmap as we are building Gemini 4 as well.
Your next question comes from Michael Nathanson with MoffettNathanson. Your line is now open.
Thanks. Thank you. One for Sundar and one for Anat. Sundar, just keep with the model theme of this call. Can you talk a bit about what do you think the moats are to this new model war, right? What is your strategic advantages that fuel your business, that even if everyone gets to the same type of model capabilities, what gives you the edge to keep growing like you're doing? And then Anat, back to Eric's question, anything you tell about the margin impact on TPUs going forward, right? Is it incremental margin to the core cloud margin, or is it a lower margin from the group? Thanks.
Look, Michael, I mean, first of all, look, there are many layers at which we are providing solutions, right? I think part of what the value of our full stack approach is, customers are coming to us for solutions. So if you take an area like cybersecurity or data analytics, people are deploying solutions in which models are an ingredient in that solution, right? So take cyber, people are using Chronicle and Viz, and with our upcoming CodeMender product, they're using it to detect and patch vulnerabilities and so on. Or take data analytics, people are bringing what's been in the past siloed data sources, putting it all together, and having an intelligence layer on top of it with Gemini Enterprise. And so the model is just an ingredient in those solutions. So I think it's important to remember that. Then even within where you're purely on a more model consumption area, people are, there is what looks as models are increasingly becoming end-to-end orchestrated systems, right? Workflows, agentic workflows. And to develop all this, it's your ability not just to bring the compute you need to train and serve, the data quality, the environments you have, your ability to continually improve, provide customers with that peace of mind that all the data they have, their data, their trajectories are confidential to them. None of that in any way flows back to the models. Their ability to configure and serve all this in a secure way and manage it and provision it and so on. So these are big end-to-end things. And so this is what our cloud business as a whole is focused on building it. And, and we are seeing demand across all of these components. And so obviously having our own models allows us to really optimize these solutions and bring an integrated offering. But we will also provide other models as part of these solutions. We also bring infrastructure as part of these solutions, etc., and take a whole full stack approach. So I think we are very, very well positioned there.
And on the TPU margins, we don't break out margins for any specific products or infrastructure component. And certainly there are benefits from designing and manufacturing our own chips. But the way to think about it is this is an expansion of our total addressable market. So it expands the opportunities by providing solutions to customers that need those systems in their data centers. But overall, if you think about the cloud margins, obviously a really fantastic expansion of margin to 35.6% this quarter, outstanding, strong operational discipline across the business and leveraging growth in the top line. And now as you think about Q3 and through the remainder of the year, and I've mentioned some of it in the prepared remarks, given the supply constraint environment we're in, we are planning to expand the use of third-party capacity in Q3 as a bridging strategy, while we continue to build out internal capacity. That capacity, given the cost of that capacity, will put some pressure on operating margins for cloud. And then the last item we mentioned in the past was the integration of Wiz does create some headwind here in the near term in 2026 related to the acquisition.
Thanks, guys.
The next question comes from Mark Shmulik with Bernstein. Your line is now open.
Yes, thanks for taking the questions. Anat, just on these third-party deals and kind of the bridge and capacity, is there a particular objective where the constraints are most severe, or is it really broad-based? And I guess, stepping back a bit and thinking about capacity allocation across the businesses, has that changed at all, or is there a way to contextualize how you're now thinking about the trade-off between allocating compute to search versus model training versus for the GCP business? Thank you.
Mark, I can comment on it. Look, again, on allocation, I think, the baseline with which we start is what it takes to, continue AGI development at the frontier. Obviously, the priors on that are just based on where the model frontier moves. And so we start with that as a baseline. And beyond that, we want to obviously, we are prioritizing our core product areas like search, YouTube, etc., as well as cloud. And within cloud, we are prioritizing the compute to make sure we can serve our models, in the context of Vertex and Gemini Enterprise and our core solutions, be it data analytics and cybersecurity, etc. Right? So our core serving for our core products across consumers and enterprises, where the compute is primarily going, and that's how we think about it. I think on the bridge deal, the main thing I would say is, look, there are on the margin, there are very, very large customers of ours on cloud who we are trying to support them through this extraordinary moment, and the incremental opportunities they are bringing to us, while a short-term cost over a few months may be very high, in the lifetime of the deal, as we bring more capacity on, is highly ROI positive, right? So those are factors we are taking into account. So are you willing to, take upfront 6-month deal to be able to serve that customer in what is a multi-year opportunity, where the margins and the returns are very, very attractive over that multi-year horizon? So hopefully that gives some color on how we thought about those opportunities.
The next question comes from Ron Josey with Citi. Your line is now open.
Great, thanks for taking the question. Maybe I'll switch topics somewhat and Philip, ask you a little bit more about monetization from a search and YouTube perspective. Just given the greater signal we have with AI searches, and then you talked about YouTube strength. Talk to us a little bit more on how advertisers are leveraging the greater personalization and targeting that Google has to drive this ROAS. And a question we often get is, Google is at size and scale, we're still growing 17%. Any reasons what's driving that all-time high on searches? Thank you.
Yes, thank you so much for the question. Look, our 17% year-over-year growth rate in the Q2 search and other revenues was really driven by many parts of our business working well together and very, very deep Gemini integration. maybe to zoom out for a second, all the major verticals contributed to the growth. Retail drove the greatest contribution, managed as followed by really meaningful contributions from finance, tech, media, entertainment, and so on. I think it's really important to understand that Gemini supercharges our ability, and this goes specifically to your question, to understand what people are looking for and match the right ads. So we're applying Gemini models really across our entire ads infrastructure, whether it's ads quality, advertising tools, ads and new AI experiences. And we're really deeply integrating Gemini into the customer tools to make the campaigns more efficient, which comes on top of this. And then we have our AI-powered campaigns like AI Max that help advertisers actually adapt and find the opportunities beyond keyword. Again, that's an ability for us to go deeper and target better. And AI Max continues to unlock, we mentioned this, billions of net new searches that weren't really monetizable before. And then on the YouTube side, high level, the ads growth was driven by direct response and brand advertising. I shared earlier, we continue to see a lot of momentum in the living room. We have a really exciting ads roadmap as well ahead of us on the brand side, on the direct response side. Demand gen and shorts remain really interesting opportunities here. Again, this has targeting components to it, obviously. And we continue to innovate really heavily in direct response with shoppable ad formats in the living room, which will help us drive strength in retail as well.
Your next question comes from Ken Goralski with Wells Fargo. Your line is now open.
Thank you very much. Two questions, please. First, how would you assess the forecasted returns on compute capacity investments in 27 compared to prior years, 25 and 26, in light of the supply chain constraints and supply chain inflation we're seeing? I'm curious as to how you think about the return profile of 27 and kind of future investments versus past investments in capacity. And the second one, a little different topic here. When you think about Waymo, what are the key factors you would consider when evaluating a change in corporate structure for Waymo? I know you've previously been reticent to talk about this, but the business is scaling. Clearly, there's leadership there and has a lot of momentum. Under what conditions would it make sense for Waymo to live outside of Alphabet? Thank you.
Look, Ken, on your first question, if I understand it, we are working off a discipline ROIC framework here. Obviously, we, to the extent that our input costs going up to us, we reflect that, in our ability to, price our solutions and see returns there. So all of that is factored into how we are planning. I think our compute capacity investments in 27, I think to the first question I answered, I think we are, we are seeing strong demand indicators, including long-term deals, the existing deals which we have, which are renewing with exceptional demand on a moving forward basis. And so we are using all that to plan and invest accordingly. And so, I think if anything, the dynamics look healthier than where we were about a year ago. And so that's what gives us the confidence to undertake those investments. On Waymo, look, I think we are really focused on executing and scaling up Waymo. We have set it up with our bet structure and given the team a lot of support. Alphabet has continued. I think our ability to think and plan long term and invest in the business is and give them that long term roadmap. The confidence in undertaking a long term roadmap and scaling up, I think is all hugely valuable. We're really focused on scaling the business right now and executing to that extraordinary potential, and that's what we are focused on.
Thank you very much.
Our last question comes from Shreya Kajuria with Wolfe Research. Your line is now open.
Okay, thanks a lot for taking my questions. Could I please ask you two? One is on TPU long-term strategy. longer term, is it fair to think that as TPU sales scale, you'd build merchant silicon business with a software stack that goes with it? And second is on YouTube revenue. Given how strong engagement is, what are some of the factors that could drive accelerating growth rate at YouTube on a go-forward basis? Thank you.
Maybe I'll answer the first one, and Philip can broadly talk about YouTube revenue growth as well. On the first one on TPUs, look, I think we've been operating with TPUs for a while. A lot of our cloud serving is done on TPUs, and we are also seeing strong demand for TPUs as standalone systems from other customers. And so obviously the industry has constraints too. So we have to plan and we allocate on a forward-looking basis along the principles I spoke about earlier. So I don't want to project out too far into the future there, but I do think we are, obviously we will scale up based on the opportunities we see and the demand we see, commensurate with the constraints that exist and the allocation needs we have for frontier model development, making sure we can serve our consumer businesses and enterprise businesses well. And Philip, you want to add on YouTube monetization?
Yes, thank you so much. So look, I mentioned it, the drivers of YouTube ads revenue growth. I think there's a lot of things we're actually excited about when we look at our ads roadmap here. In brand, we see ongoing opportunities on connected TVs in the living room. We're building tools to help advertisers find creators, scale across screens, and then measure the results. And we have a slate of new and returning creator shows that are coming exclusively to YouTube. We see opportunities in direct response, particularly with demand gen, and shorts. I mentioned it remain a really interesting opportunity here to expand our base to more small and medium advertisers across more verticals, shorter videos. Actually, this important one, create more opportunities for less disruptive ads, increasing the overall ad effectiveness. So we're going to continue to see a lot of innovation, in my opinion, in direct response with shoppable ad formats in the living room, which, again, we mentioned that drives retail strength. We announced a few other formats here at Brandcast. We announced Buy with Google Pay to enable CTV viewers to actually complete purchases directly on their TV with 2 clicks, which is a really interesting opportunity over time. We launched the Affiliate Partnership Boost to drive incremental sales and the creator earnings, obviously, from YouTube shopping affiliate commissions. So overall, frankly, very, very exciting times.
Thanks, Sundar. Thanks, Philip.
Thank you. And that concludes our question and answer session for today. I'd like to turn the conference back over to Jim Friedland for any.
All right. Okay. So let me very quickly fill in the Tesla numbers, and then we'll jump in. I believe the Tesla earnings call is starting soon. I do not want to. It's still the music now, if I'm not mistaken. Oh, no, it's not. Okay, sorry. We'll jump into the Tesla earnings call, and then we will talk more after the earnings call.
A car with FSD, they're coming into our stores in the US and saying they want the full self-driving, and with whatever car it comes with, essentially. So clearly, this is a significant demand driver, and as we get approval for FSD in different countries, I think we'll see a similar uptick in demand. Yeah, it's looking very good on that front. The energy business is also growing incredibly fast, and I think will be crucial for the scale up of artificial intelligence data centers. We're investing a lot in growing the core business and really preparing for the future. So this is a massive CapEx year, but I'm confident that all the things that we're investing in are what will yield incredible returns. Really made the best CapEx returns that we've ever seen. And just the Tesla team has performed incredibly well. The Cybercab has started production, and we also have started production and are ramping in. We will soon start production with Optimus. We have started production with the Tesla semi truck. We will soon start production with Megapack 3. We've started production with the lithium refinery, the cathode refinery. We're scaling up battery cell production, and we're also preparing to do a massive solar panel, like solar cells and panel production. Actually, this is going all the way from silicon refinement to producing the solar cell and then deployment of solar, because there's going to be tremendous need for electricity in the future due to electrification of transport and AI, obviously. So we're working on what we believe is the most ambitious build-out of advanced infrastructure and manufacturing capacity ever in history. It's a big deal. So with Robotaxi, our goals are very ambitious for Robotaxi, but we do need to be cautious about causing any accidents or causing any harm to anyone. Although there are, I think, 30 to 40,000 automotive deaths per year in the United States alone, most of those do not generate any press on it. You never really read about almost any of those. But if we injure even one person, it will be worldwide headline news, and regulators will immediately clamp down on our activities. So, and we don't want to injure anyone. So we're going as fast as humanly possible in scaling Robotaxi, but while trying to ensure that we do not harm anyone at all, and ideally do not even run over a pet. So that's really the constraint. Is we want to grow as fast as possible with Robotaxi without harm to anyone. And we're providing live updates for Robotaxi launch as we open up in a city. We immediately post that on X. So if you just follow the Tesla account on X, we'll keep you informed as we scale to new cities. We've opened up in a number of cities in Florida and in Texas, and obviously in the Bay Area. So we'll continue to scale, I think, very, very rapidly it looks like more than 10% a week in terms of miles driven. So it's a very high compound growth rate. So let's see, Optimus. As you've heard me say before, I think Optimus will be the biggest product ever, but it is a very complex problem to solve. It's one of the hardest things to solve, to make an autonomous humanoid robot that can do tasks that if you simply ask it to do something or show it a video, it can do the task without any programming. Like no one's ever achieved this, and there are many challenges in the electromechanical design of the robot to achieve sufficient dexterity and also be very reliable and have long wear and tear. Like meaning it needs to be out in the field and not break down. Otherwise, you've got sort of a 70-kilogram robot that just flopped over, and you got to carry it out like a buddy. It doesn't have wheels. So and we don't want Optimus to go haywire. It's a lot of work to scale to get the design right and to scale production. And I really want to emphasize here that the production scaling challenge is very substantial. This is going to be the hardest product to scale manufacturing that we've ever made at Tesla, because everything on the robot is new, and the difficulty of scaling the production ramp is proportionate to the newness of the parts in the robot. And at least with electric cars, the non-electric powertrain portions of the cars had an existing supply chain. So you could go to existing suppliers for wheels and side mirrors and windshield glass and that kind of thing, body panels. But with Optimus, there is no supply chain. So we've had to build up a supply chain in its entirety, or in-house the production, and we actually in-house a tremendous amount. The Optimus production line that we're building out in Fremont, in place of what used to be the Model SX production, it looks incredible. I mean, it's quite stunning to see. So I just want to make sure to calibrate people correctly. Optimus will follow the sort of normal S curve of manufacturing, of a manufacturing ramp, but the initial portion of the X curve will be quite flat and long because of the newness of the parts in the robot. You've probably seen lots of impressive demonstrations of robots on the internet, but those demonstrations you're seeing are pre-programmed or remote controlled. So there is no humanoid robot that is actually able to do generalized tasks. Optimus will be the first one that is capable of doing that, where it's not just a demo; it's genuinely useful in day-to-day life. So, and Optimus is designed to have full human dexterity, so a hand that has the same level of dexterity, if not higher, than a human hand. And the human hand is an incredible thing. The more you study the human hand, the more amazing you realize how amazing hands are. It's more than just opposable thumbs. I mean, the nuances of how human hands work are amazing. As the closer you look, the more amazed you are. And Optimus will have that capability. You'll have human and then superhuman dexterity. So it's really going to be quite something. Let's see, Terafab. The Terafab, we expect to announce the location soon, and provide more details about our plans in that regard, which we'll leave that to the product, sort of the launch announcement, rather than try to squeeze it into an earnings call, because I think this is a very big announcement, and it deserves to have its own sort of day in the spotlight and not be sort of squeezed into an earnings call. But I do think Terafab is going to be an amazing initiative and a necessary one, and one without which we will be constrained in our ability to scale Optimus production, because we simply won't have enough AI chips. So it's crucial to solve that, and we'll have to solve memory, logic, and packaging in order to scale Optimus. But anyway, like I said, we'll leave that to its own announcement. We've placed equipment orders for our development fab in Austin, and that development fab, I think, is pretty cool because it's intended to have lithography mask production, and then logic, memory, and packaging and chip testing all under one roof. So you can have a very fast iterative cycle, and try out new chip designs very quickly and see if they work. I don't think such a building exists anywhere on Earth. So this is really going to be super helpful as we try some exciting, adventurous, high risk, high payoff bets on AI chips. But it's focused, like I said, primarily on Optimus. Like, how do we make Optimus as useful as possible? Then we have we have digital Optimus, which is basically driving a computer screen. I guess you could call it computer use or something like that. But driving a computer screen in the same way that you drive a car. So for the car, it's sort of pixels in or photons in and controls out. The same thing is true for Optimus and digital Optimus. It's photons in, controls out. So we feel confident we can adapt the same Tesla AI technology that we developed for self-driving cars to have a self-driving computer screen, or self-driving computer, essentially. So the self-driving computer, where the Tesla, the very low cost Tesla AI4 computer can handle all of the sort of short-term tasks. They're doing real-time video control of the screen of the computer. So it's not like screenshots type of thing. It's real-time video. And
I would think quantum is still quite a bit away. Robotics, I can see
digital optimists will be important, obviously, for physical optimists, because physical optimist needs to be able to operate computers. It's like it can't come up to a touchscreen and not know what to do. It's got to have a generalized touchscreen and computer use capability. So that's looking promising. Then this is in partnership with SpaceX's Grok. So the big model that is kind of like the manager of digital optimists, and kind of tells digital optimists what to do, provides it with a series of tasks, and then digital optimist goes and does those tasks. We're also building out a megapod design that has Tesla AI4 computers with x86. It's a pairing x86 computer with the Tesla AI4 computer in a box. And it's kind of just digital optimist in a box. And in a megapod, kind of like the megapack packaging. And so where we put just a large number of AI4 plus x86 combos in a giant box, essentially. And that these boxes can be placed anywhere in the country or outside the country. And this allows us to scale AI compute using disaggregated electricity production. So because there's lots of places all around the world, including at our superchargers. I think we've got something like 7 gigawatts of power at our superchargers and growing. And we can place megapods at many of these superchargers and have distributed power for AI. So I think that could be quite a big deal. So in conclusion, we're super excited about our autonomy and robotics roadmap. There's so much awesome stuff coming. It's like I said, hard to squeeze into an earnings call. But we'll have a lot of product announcements. And this is going to be a great year for Tesla. I think one of our best years ever. And then I think next year will be even better. So in conclusion, I want to thank the Tesla team for their excellent execution and all of our supporters for joining us in this journey. Thank you.
Great. Thanks so much, Elon. And now Vaibhav has some opening remarks.
Thanks, Travis. So Q2 continued the trend that we saw at the end of Q1, a resurgence in demand for vehicles across the globe. We achieved record Q2 deliveries globally with sequential growth across the Americas, APAC, and EMEA of 60%, 27%, and 12% respectively. Additionally, Model Y set records in several key markets, including the Netherlands, Australia, and New Zealand. The efforts of the Tesla team to create compelling products at a reasonable price with the capability of autonomous driving are coming to fruition. We exited Q2 with our largest order backlog since 2023. We are therefore focused on increasing production at all our factories to meet this growing demand. Production growth will be limited by our supply chain. This includes not just batteries, but also electronic components. We've been here before, and like always, our Tesla team is working actively to unblock the obstacles ahead by securing strategic deals with suppliers. Like Elon mentioned, one of the key factors for vehicle demand has been FSD. Our sales data suggests one of the main reasons customers are coming and looking at the car is because of FSD. In Q2, we had in North America, about 55% of our deliveries had FSD subscription at the time of delivery enabled. Overall, FSD attach rates continue to improve, reaching nearly 1.5 million paid customers globally, of which 55% is upfront purchases, and the remaining 45% is subscriptions. We expect that the bulk of the growth in FSD monetization will come from subscriptions as we've removed the purchase option in most markets. Automotive margins, excluding regulatory credits, declined sequentially from 19.2% to 16.3%. As a reminder, we had highlighted in Q1 that we had a $230 million benefit from warranty true-downs and some tariff relief, which did not repeat in Q2. Controlling for the impact of those benefits from the prior quarter, our automotive gross margins, excluding credits, would have been approximately flat. This demonstrates the effective pricing and cost management done by the Tesla team as we continue to drive demand. Commodity price increases and interest rate changes all continue to add to our costs. Note that interest rate subvention costs are recognized upfront as revenue offset. So as interest rates have risen this year, the cost of subvention has risen along with them, which had a negative impact on automotive margins. As we have previously noted, energy business is inherently lumpy. Deployments are tied to customer timelines and largely out of our control. In Q2, we deployed 13.5 gigawatt hour of energy storage, a 53% sequential increase, and the second largest quarter for energy business. Despite this growth, energy gross margins declined from 39.5% to 20.4%. This margin decline was a result of several dynamics. First, there was a warranty true-up in the quarter of about $240 million related to certain vendor cell issues for our legacy deployments. Also, the tariff benefits we recognized in Q1 of more than $200 million did not repeat. And lastly, we had previously guided that ASPs for industrial storage is coming down amidst growing competition. Long term, we believe the energy business should normalize at a gross margin rate in the mid to low 20% range. Our order backlog of this business is robust, and we are doing our best to build based on both existing demand and future demand we expect from data center growth and overall electrification of the economy. Service and other margins improved sequentially from 9.2% to 14.1%, an all-time high. This was mainly driven by an uptick in volume and better cost management of our vehicle fleet that supports businesses such as used car, supercharging, service centers, and insurance. While marginal today, also included in this business are deliberate investments we are making in infrastructure that will help scale robotaxi in the future. We continue to grow the Tesla robotaxi fleet and have expanded to a total of 7 markets in the US. We expect the ramp of the fleet to accelerate throughout the year, along with expansion into new US markets. As previously guided, operating expenses increased sequentially. The increase came primarily from significant research and development related activities, including pre-production ramp costs for new products like the semi-truck, Optimus, Cybercab, and other AI initiatives, as well as depreciation for an additional compute that we brought online. Additionally, we had charges related to litigation expenses in the quarter. Note that we are in a big investment cycle and expect our operating expenses, largely driven by R&D, to continue to grow in 2026 and beyond. Net income was positively impacted by a mark-to-market gain of $1 billion on our SpaceX holdings, which was offset by losses on FX of approximately $300 million and on Bitcoin of about $100 million. As previously guided, our free cash flow ended up being negative for the quarter. Most of the reason for it going negative is because CapEx more than doubled sequentially, and we expect it to increase further in the second half of 2026. We continue to expect that CapEx for this year will be more than $25 billion. CapEx will grow for the next 2 or 3 years as we expand our robotaxi fleet, expand our production capacity for Optimus, make investments for semiconductor fab, install solar manufacturing capacity, and AI compute infrastructure, in addition to all the other expansions we'll do for other manufacturing for automotive. In addition to using our cash for such investments, we are being opportunistic in securing certain debt facilities that will give us the capacity to borrow up to $30 billion to help accelerate such investments. We believe this is the right strategy to position the company for the next era, and we'll always make such investment in a very capital efficient manner. The path to amazing abundance is ever challenging and requires making bold bets. Our progress will be non-linear. The future is going to be great, and we are ready to rise to the occasion. I would like to end by thanking the Tesla team, our customers, investors, and suppliers for their confidence in us on this journey.
Thanks so much, Vaibhav. As everyone on the call may have noticed, we've covered several of the say.com questions already in opening remarks, including Optimus Production, Terafab, and Digital Optimus. Ashok is joining us today, our VP of AI, and he's going to cover questions related to robotaxi. Ashok?
Thank you, Travis. Many of the questions on say.com relate to robotaxi deployment and scaling, so we thought we'd provide a comprehensive view of where we are now and where we are going in the future. First of all, I'd like to state that the robotaxi program has been operating extremely well. Especially in terms of safety, the program has had an impeccable safety record. We have driven more than 380,000 miles of unsupervised robotaxi, now across 6 cities in 2 different states. We have had 0 notable incidents. Any reports have been of other actors impacting us when we were stationary. Again, I'd like to emphasize how safe the operation has been so far. 0 notable incidents over 380,000 miles. Historically, the so-called experts have always claimed that you need LiDARs, radars, HD maps, and the entire kitchen sink to drive safely. Here we show that such is not true. You can have safe, comfortable, and affordable autonomy with just cameras. This record should be a huge validation of Tesla's entire AI approach. Second, I'd like to discuss scaling. We started the robotaxi program roughly a year ago in Austin. We had safety monitors in the passenger seats of the cars back then. Around the end of last year, we had the first fully unsupervised robotaxis in Austin. Since the beginning of this year, we have grown at double-digit growth rates to the number of unsupervised miles that the fleet drives every week. I repeat, we have grown at such a high compounding rate on a week-over-week basis over the last several months. Not only that, we expect to continue growing at such a large rate through the rest of this year. The other thing to note is that for expanding to new cities, it has been relatively less effort on our front. We expect that the time to launch to a new city will continue to trend towards 0, towards an end where we operate in entire states as a whole instead of going by city by city. Such growth was only possible because we have a world-class engineering team at the frontier AI development here at Tesla. The currently operating robotaxi fleet is already running early versions of the V15 FSD software that we had referred to in the past. For V15, we had planned roughly about 7 major improvement tracks, and they're all happening in parallel. The early V15 builds that are running on robotaxi have already 40% of those tracks merged together, and that's what's running in the fleet right now. As we continue to complete our work on V15, we will see that the car is going to be ridiculously safe and capable. We're already seeing internal signs that all of these bets that we have made for technology improvements are all starting to work, and we expect that the payoff will be huge, and that's what is going to help us sustain the same growth rate through the rest of this year and so on. Finally, regarding the Cybercab, first of all, it's a phenomenal product. Anyone who rides in it instantly falls in love with the experience. We have aligned our manufacturing targets to roughly match the projected growth rate of the unsupervised miles. The same V15 models that power the Model Y and other platforms will also work on Cybercabs. In conclusion, robotaxi growth so far has been literally exponential, while keeping an impeccable safety record. Our technology bets are paying off, helping us sustain the exponential growth for the foreseeable future. And the cybercab is going to be awesome.
That's great. Thanks so much, Ashok. And there was one remaining question on data collection for Optimus training. Would you mind covering that as well?
Yep, definitely. Regarding Optimus, especially Gen 3, Optimus has been designed to not just match the appearance of human beings, but also the functionality and dexterity of humans. One of the main reasons for this approach is that having the human form factor and function allows us to learn from humans on how to perform a wide variety of tasks. This opens up the entire world to provide data for training Optimus. Just like FSD, we have access to a broad fleet of humans giving us data from all of the workers at our factory. Optimus can learn quite a bit from observing them perform their tasks at the factories. We also have a dedicated data collection team who can provide a relatively small amount, but of very high quality demonstrations to do the post-training of these models. This is all on top of any training we can do off of the entire internet of data that shows demonstrations of people doing various tasks, both in industrial settings and home settings. The second flywheel is when we have a large number of Optimus robots practicing their tasks in what we call the Optimus Academy. The data from the bots experiencing the tasks themselves will be invaluable and help us close any minor form factor gaps that may exist between the bot and the humans. This is also when the reinforcement learning loop kicks in, where the bot initially attempts some tasks, fails sometimes, learns from both the successes and failures of those tasks, and eventually learns to master those tasks at perhaps a superhuman level. Our AI strategy for Optimus is aligned with the same. It's the same end-to-end strategy that drives FSD, pixels in, controls out. And just like FSD, we expect it to work broadly. In FSD, you can get in the car, type in an address, and then hit start, and it's like handles all of driving from park to park. And the same thing is going to be true for Optimus as well. You're going to just ask it to do anything, and then it should just perform the entire task on its own without you having to do anything along the way. And it's the same team that produced FSD, the V12, 13, 14, and now V15 software that now works on Optimus as well. And so I'm very confident that Optimus will be an extremely capable robot.
Great. Thank you so much, Ashok. So that covers the say.com questions. Now we will move over to analyst questions. The first question comes from Tom from RBC. Tom, please feel free to unmute yourself when you're ready. Tom, you're still on mute, so please unmute yourself and go ahead and ask your question. All right, we're not getting any audio from Tom at the moment, so we will try to move on to Andrew, and we'll add Tom back to the queue to come in next. So Andrew, as soon as you can, please unmute yourself and ask your question.
Hey, can you hear me?
Yes, we can.
Awesome. Thanks so much for taking the question. So maybe just to start out on Optimus, Elon, you mentioned that there's really no supply chain today for Optimus, so you've had to mostly insource a lot of that yourself. I'm just curious, as you've gone through this exercise, are you seeing any suppliers willing to invest alongside you to set up domestic manufacturing to potentially help you scale more quickly in the U.S.? Asking that in the context of obviously, you want to control your own destiny to some extent and ramp as quickly as possible, but from an investment cycle standpoint, potentially more capital efficient to have some partners, help you along the way. So I'm just curious how you're thinking about that and some of the dialogue you've had with potentially some external suppliers.
Elon, you may be on mute right now. We can't hear you.
So yeah, our supplies have been great, and they have made and are making tremendous investments in support of Optimus and robotaxi and whatnot. Samsung and TSMC in particular are building fabs, TSMC in Arizona and Samsung in Texas, and putting in tens of billions of dollars to build AI compute for Optimus and Robotaxi. Panasonic has also invested many billions in increasing battery cell production. I'm a little under the weather here. I'm a bit ill, so if I sound a little off, I'm kind of struggling with I'm a little bit ill today. So yeah, but our partners have been great, and I'd like to thank them for their support and their investment and their hard work.
Great, thanks for that. And maybe just as a
So,
follow-up.
sorry, Andrew, we're going to have Karn hop in here for additional color briefly.
Yeah, just to add to Elon's point, that the Samsung fab, that's going to be pretty significantly dedicated to future projects. That's a massive investment, multi-billion-dollar. We're seeing the same level of investment going to memory, and also new specific parts like metal injection molded parts, flexible printed circuits, and all sorts of novel new technologies that are more based for the robot as opposed to the traditional vehicle supply chain we've had. And in certain cases where we don't find a great partner, we've never hesitated from insourcing it, and we have a very capable manufacturing engineering team and a design team that helps us scale those things.
Yeah, and actually, I'd also like to thank Micron for giving us a memory allocation. They're going to make some very tough decisions on memory allocation, and we really appreciate Micron making room for Tesla in the years to come, and giving us actually a very significant allocation on reasonable terms, given the pretty insane pricing of memory these days.
Great, really appreciate that color. And maybe just my follow-up on robotaxis. You guys gave a lot of great information in your prepared remarks, but there seems to be some evolving regulations at the state level, potentially around sensor requirements. So I'm just curious, as you think about your own rollout, what do you want to see, or what do you need to see from regulators to make sure that, obviously some regulation might be good, but you don't want it to be over-regulated. So what are you expecting to see? What do you want to see to make sure that this is, done in a proper way?
And we've got Lars on the line. Lars, if you wouldn't mind covering this one, if you can.
Yeah, sure, Travis. I think, when we talk about regulation, particularly in the U.S., we've made a lot of headway. Just good initiatives from the federal government in terms of the FMVSS rules, moving towards, acceptance and adoption of purely built AVs, and I really appreciate the support from NHTSA on that. When it comes to like a state-to-state level, obviously the stuff in New Jersey, is a little bit disheartening. I think ultimately, as Ashok said in his opening remarks, we really focus on the performance of the vehicle, and ultimately that's what's going to drive regulators and the public to adopt it. I think the best regulations are those that provide companies and innovators with a goal or a task and allow us to figure out the solution. And when we see regulations that provide a solution before identifying the problem, we really don't, appreciate those. But as Tesla always has and will continue to do, we'll let our performance speak for itself. And I think Ashok played that out really clearly, and that'll be the foundation of our expansion moving forward.
Great, thanks for the questions.
Thanks so much. We're going to try Tom again from RBC. Tom, can you unmute and try to speak, please? Unfortunately, Tom, we see you unmuted, but we're not hearing you, so we're going to have to send you back into the queue. Next is Alex from Bank of America. Alex, as soon as you can, please unmute yourself.
Hey, thanks for the questions here. Just a few follow-ups on Robotaxi, actually. I guess, what milestones should investors be watching from here that would cause you to accelerate your fleet scaling or market deployments? Is it the further safety validation, like a miles driven per incident, or something else? And then, would you ever consider third-party distribution partnerships, such as with rideshare providers, to increase utilization, or is the plan for now to keep robotaxi fully vertically integrated? Thanks.
Yeah, we expect to be vertically integrated with robotaxi as we are in the rest of our business. So I don't think we're going to have any demand challenges with robotaxi. So this is the economics will be so compelling that I think we will really have a lot more desire to use the service than like I think demand will outstrip our ability to service the demand. And so obviously there's no you can just go vertical in that situation. So it's really just about going through and what we call the march of nines of reliability, where you need like how many nines of reliability do you need to scale? Ideally, you want 99.99999% reliable, and so that's it's just the march of nines of reliability is I think the only thing really constraining our growth in robotaxi.
Great. Thanks, Elon. The next question is going to come from Colin at Wells Fargo. Colin, please unmute yourself when you're ready.
Oh, great. Thanks for taking my questions. There's been a lot of chatter about SpaceX and Tesla combining in some way. I mean, a lot of collaboration already today. I mean, Elon, do you see synergies eventually from combining the companies? And does that make sense from your perspective over time?
Well, I mean, as you can tell from all the many collaborations on so many fronts with SpaceX, and there's more and more overlap, especially with Terafab. That's really going to be a gigantic project. So, but obviously we can't talk about combining companies and that kind of thing on an earnings call. It's got to be done with the appropriate process. And with that, I'll turn it over to Brandon, our General Counsel.
Yeah, no, thanks, Elon. And that's exactly right. We continue to benefit from our relationship with SpaceX, and they've been a great partner, and we have numerous beneficial transactions with them. And earlier this year, we deepened our relationship through an investment and a framework agreement. And this will allow us to continue to work with them on projects that Elon mentioned, like Terafab and digital optics.
Yeah, and there's many other things too. Obviously, you've got Grok in the car, and Grok helping drive digital optimists. You've also got Starlink being integrated into the Cybercab, and Starlink will be integrated into all of our vehicles, at least for markets that Starlink is active. Because for a robotaxi situation, you need to have coverage everywhere. And there are many places, even in Silicon Valley, where the cellular coverage is terrible or sometimes non-existent, which is surprising for Silicon Valley. But I know when I drive to work, those first 10-15 minutes, I can't actually do any calls because the cellular connectivity is so bad. So we can't have robotaxis getting stuck in these like Bermuda triangles of lack of cellular connectivity. So Starlink, with its ability to do connectivity anywhere, is actually quite important. So we don't have robotaxis missing in action. And then obviously if people are sitting in the car, they're going to want to do high productivity stuff or what entertainment. And with Starlink, you can watch 4K live sports in the car, and with very low cost per gigabyte of data. That's really not feasible via the cellular system. And there's many other situations.
Yeah, I mean, I would think of it like Ashok was mentioning about Cybercab, right? That the experience is great. In a world when you don't have to focus on driving, you have all the time in the car to do, whether it's a conference call, watch a movie or anything. That's why if you look at the Cybercab design, it has a big screen. And we've started doing Cybercab rides in our factory in Austin. And when you go through that experience, soon customers would be able to do it in not too distant future. And then you'll understand why that connectivity becomes so important.
Great. And then Colin, do you have a follow-up?
Yeah, just if I would follow up on Robotaxi, if I look at the launches, you've been adding cities, but the number of units is still, looks like based on media reports, sort of in the dozens as opposed to hundreds. Why not just sort of scale up Austin or one or two cities before adding cities? And sort of what do you need to sort of get that, higher volume numbers in a major city? What sort of is the roadblock to sort of adding more vehicles on the ground?
Yeah, the reason we have been expanding across different cities instead of just doubling down on a single city is that we want to make sure that our stack is a very general one. It is a general one. We just want to both prove to ourselves and to other folks that it is working across a lot of different cities without too much effort per city. And that's what we see internally. And then, as Elon mentioned earlier, the growth rate has been literally exponential. Just it's in the early part of the exponential. That's why it's hard for others to comprehend. In terms of miles versus the vehicles, since these vehicles operating the robotaxi fleet drive basically continuously, as opposed to human drivers who use vehicles for maybe a couple hours a day or something like that, these vehicles are in mostly continuous operation, which means that even for a few vehicles, you can get a lot of miles out of them. And that's why we are tracking the amount of unsupervised miles or just the number of vehicles or something like that. And we want to be operating in a very efficient fleet. So all of the work that goes into the efficiency makes it even more so that we get a lot of miles per vehicle available in the fleet.
Yeah, and just to add further to this, think of it, we're trying to scale this, and we're trying to make sure that there are different kinks which would be there. And there are things not just on the software front, on the operation front, which we're also trying to tackle. So that's why we're trying to have a broader footprint to try and make sure before we go really high in terms of deployment, that we are able to sort these things out in a smaller fleet in a controlled manner.
Yeah, one of the things for Cybercab should be noted is because it is a new vehicle chassis, we need to accumulate driving data that is specific to the Cybercab before we can put a lot of them on the road. So unlike say Model 3 and Model Y and our other vehicles, where we've got a lot of vehicles on the road, millions of vehicles on the road, we don't have that for Cybercab, so we actually have to accumulate miles with Cybercabs that are retrofitted with steering wheels and brakes, acceleration, braking pedals, that kind of thing, to calibrate to the Cybercab chassis. So you'll see as we are confident about that, the number of Cybercabs in cities will increase dramatically.
Great. Our next question is going to come. Oh, yeah, go ahead, Lars.
If I can just add one thought here. The other reason I just want to point out is, TCO, transportation regulatory situations are different city by city, state by state. It is not a federal, framework to do that. And so the reason we're expanding city by city is to make sure that we're meeting all of those one at a time, and we're satisfying, all of the requests of each individual city and in everywhere we can. And so we have to expand, to each city to meet those requirements, and we'll continue to do so. And until all of what Ashok and Vaibhav and Ashok said, we'll follow with the scaling.
Thanks, Lars. The next question is coming from Walt from Lightshed. Walt, please unmute yourself.
Thanks. Just a quick follow-up for that Lars comment. I mean, the NHTSA administrator, Jonathan Morrison, was just on CNBC. He already, he's trying to get rid of the pedal and said, I forget his exact term, but it seemed like he wanted to get rid of the steering wheel. It seemed like that would be a gating factor. But is there other things that you need at the federal level to really kind of unlock your ability to ramp Cybercab?
The short answer is no. I think we have a great relationship with NHTSA and Director Administrator Morrison especially. And I think they're just following through with what the public wants and the world knows is coming, and they're trying to stay ahead of it and make sure that they're doing the right things in place. So we've been open and honest with them for the last couple of years about what our plans were and what we're doing, and I don't want to say we're in lockstep, but I feel like we have a partner there, and we're working together on it.
Got it. And then just Elon, it's kind of a roadmap question, I guess. Starlink obviously is integrated in Cybercab, and you guys just talked about the connectivity for watching movies. But what about the flip side of that? Can the Cybercabs become remote hotspots for Starlink Mobile? And then similarly, roadmap question on the Semi. When do you anticipate looking at autonomy for the Semi? Because that seems like a pretty sizable market as well in terms of autonomous trucking and the need for it, given what's going on in our country right now.
Yeah, absolutely. There, as you allude to, there is a really serious shortage of truckers. So there just aren't enough people around who want to drive trucks, which are crucial for transport throughout America. So an autonomous Semi is actually going to be very important to address the shortage of truck drivers. And obviously will be great for improving safety and making it easier on truck drivers to have a self-driving Semi is going to, I think, dramatically improve safety and comfort for truck drivers that use this as a Semi. Since the units, the total number of units of the Tesla Semi is still low and will continue to be a very small percentage even by the end of this year of our total vehicle fleet, it makes sense for us to focus our efforts, our self-driving efforts, on our high volume vehicles, so Model 3 and Y, and solving self-driving and really getting to the point where it's generalized, unsupervised self-driving for those vehicles, and Cybercab. So we expect to get self-driving working on the Tesla Semi probably around the end of this year or early next year. But I just don't want it to be a distraction on the march of nines of self-driving, of safety for self-driving on 3Y and Cybercab. That's so that it's taking a bit of a backseat for the next 6 months or so for autonomous Semi. But it will be, it will definitely be a bit working next year and in time for the scale up to high production of Tesla Semi. For communications, I think there's an interesting angle there where you could use the Starlink terminals that are in the Tesla cars as like sort of cell towers, I suppose, or connectivity towers, basically for providing relays on the ground to cell phones and to anyone who would like Wi-Fi, basically. But I mean, this is a different subject, but obviously one could do that with the stationary Starlink terminals too.
All right. Our next question is going to come from Will at Truist. Will, please unmute yourself.
Great. Thanks so much for taking my question. Elon, you teased us a little bit about sort of the supply chain relative to Optimus, highlighting how difficult it's going to be, but we'd be really interested to understand what your propensity is to manufacture semis for this yourself. When we think about microprocessors, microcontrollers, actuators, and other semiconductors that are going to be used, it occurs to me that you have many that are commercially available. You have an option to design some but have them made at third fabs. You also have the option potentially to design and make them yourself. What should we think about your propensity to source these components in these different manners?
You're talking about like making like microcontrollers and small, like the various computers that are in the car that operate, like the steering system and the braking system.
No,
that kind.
I'm talking about for Optimus, not for
Optimus has a lot of really specialized power electronics and circuit boards. It's all Tesla design stuff, but it is fabricated by suppliers. For Optimus 4, which will be built in Austin, that will be a much more vertically integrated supply system for Optimus 4, and that would we'd aim to have an order of magnitude more production of Optimus 4 than Optimus 3. So sort of aspirationally 10 million units a year versus 1 million units a year of Optimus 3. But with all the caveats there, which is insanely difficult to scale production. Yeah, Optimus 4 will be much more vertically integrated. So probably doing a lot of the sort of PCB work in-house for that.
As a follow-up, well, first, maybe you could talk about the timing as to when Optimus 4 should be, let's say, start production. But the actual follow-up I wanted to ask was the plan to upgrade hardware 3 to hardware 4 in order to be able to process, I suppose it's version 15 of the and future versions of FSD. Is that still the plan to do hardware upgrades on the cars?
I think it's going to make sense to upgrade all cars that are have less than hardware 4, almost all, any cars that have cameras, basically, because otherwise I think probably too many modifications. But anything that's got sort of that's set up for cameras, it'll be financially sensible at some point to upgrade them. But I think we'd want to upgrade them to the next generation of like next generation AI board. So it'll be either like we have an upgraded AI4 chip that's sort of a medium, sort of a moderate improvement over AI4, probably reaches production around the middle of next year. And then there's also AI5, which hopefully is in volume production around the middle of next year. AI5 will initially go into Optimus. And actually making very good progress. So the Tesla chip team is really doing great work and making incredibly fast progress on AI5. And I'm very excited about the design of the Tesla AI6 chip. I think it's going to be the best edge computing chip in the world. And if somebody's got a better one, I'd like to meet that person and shake their hand, because the AI6 chip is just so good. So I think we got things going really well on the chip front. Yeah, and again, I'd like to thank TSMC and Samsung and Micron for the support.
Great. We are coming up on the hour, but we're going to try to squeeze Dan in. So from Barclays, Dan, please unmute yourself.
Great. Thank you. Appreciate it. I'd like to ask about the pace and path of CapEx. Elon, in the past, you've said that you'll spend as much as you can, but really efficiency seems like it's the gating factor. So to what extent right now in this CapEx cycle is your pace of CapEx effectively capped simply because spending any more would be done in an inefficient manner? And to what extent is the pace of CapEx really the primary determinant right now in unlocking the different supply constraints that you have?
Yeah, it's a good question. I've actually, what I've asked the Tesla team to do is like really we should be spending on CapEx as fast as we can spend, as fast as we can without it being too wasteful. So we're not trying to aim for like some extremely high efficiency capital spend, because that would slow things down. So it's a balance between like how much sort of capital efficiency versus time. So if we can be, it's okay to be a little less capital efficient if we get things done sooner, because that's actually going to be the higher NPV outcome for the company. So overall, I'm pretty happy with how things are going. I mean, we're doing an incredible amount of construction and production growth in so many different arenas simultaneously. I don't think there's ever been a company that's done this at the scale, maybe proportionately back when Henry Ford did the Model T or something like that, or World War II when companies were making, it had to sort of scale up weapons production. But I think probably this is the fastest industrial scale up since World War II in America.
Yeah, and I will just add a little bit on that. Basically, if you look at it, all our spend on CapEx is trying to do productive assets, right? We're basically scaling factories, whether it's Optimus, whether it's CyberCab, whether it's LFP factory, which went into operation earlier this year, or the semi factory, or even putting in a semiconductor fab in there, as well as, we are trying to get a lot of solar manufacturing in the US. In fact,
yeah,
our
very important.
plants,
This is underrated, by the way. Please go ahead.
Yeah, I was going to, basically, the amount of solar manufacturing which happens in the US, we're just going to multiply it with an order of magnitude. And none of these things are easy, right? Because what you have to do is, in order to build a factory, you have to start from ground zero. So just so you know, again, I don't think we have shared this. We end up being the general contractor for almost all our construction facilities because we are doing that much construction. And so going back to what Elon was saying, we're going at a very rapid scale. And yes, this means that we are doing a lot of things all at the same time. And that's why, we just have to go as fast as we can, humanly make things work in the real world.
Yeah, but our CapEx efficiency, I think, is off scale good.
Already. And then Dan, did you have a follow-up that we can wrap up with?
Yeah, maybe just a quick question on energy storage, which I think is a key topic here. Maybe you can just address, to what extent is energy storage going to be supply constrained for the foreseeable future, and then just to what extent are the deployments right now the typical peak shaving that you'd see at utilities versus you've talked about in some of your materials. For battery storage, addressing the quality of power issue for data centers, given the sharp fluctuations in power use, where you have an advantage given software or power electronics. So just what is that demand curve right now between data centers versus just broader peak shaving for utilities?
Well, it's still mostly, it's not just peak shaving, but it's also grid balancing. So it's not just like the packs are on briefly, but for balancing power from wind generation and solar generation, batteries are awesome. The solar battery combination will be how the vast majority of energy in the world is produced in the future. That's already, of course, how all of the Starlink satellites are powered, is with solar panels and batteries. So, and you can just think of Earth like a giant satellite. There's far more power available from the sun than anything else by far, and we think power constraints are going to be there already are a major issue for AI. Just turning on the AI computers, the AI compute demand is so high that people are having even the so-called the hyperscalers are having trouble turning on their AI compute and finding the power and then smoothing the power with. Especially for the training runs where the power cycles dramatically in a very short period of time, you can have during a training run the power consumption can drop by 70% for 100 milliseconds, and you really need fast acting advanced power electronics to be able to smooth out these massive changes in power, especially during their training runs. So that's why SpaceX has bought so many megapacks for the data centers. It's actually mostly for smoothing out the power for the training runs. But it will also be useful for being able to tap more power from the grid by if you tell utilities that they can that they will not need to supply power during the the worst hours of the worst days of the year because the batteries can handle it, then that makes it much easier for them to give you power. In fact, I mean, probably the best way to scale total energy production in the United States is simply using batteries, because there's, I think, around 1.2 or 1.3 terawatts of power production in the US, but the average power usage is only half a terawatt. So you've got 2.5 times as much power generation as the average usage. That means you could potentially double the energy output of the United States just with batteries. So we see demand for Megapack being very, very high in the future.
Alrighty. That is all the time we have for today for Q&A. We appreciate everyone's questions, and we look forward to talking to you next quarter. Thank you very much.
All right. Thanks, everyone.
All right. Okay, so a couple of things happened apparently during the earnings call. Houthis seem to have attacked a ship. Oh my god, sheep. They didn't attack sheep. They attacked a ship leaving Saudi Arabia, I believe. So I mean, we are not too sure whether or not that's going to cause some of the sell-off to intensify tomorrow. We will have to see when the market opens. But if I jump into the sticks, I think the companies today have been relatively muted. So what we heard so far is that for Google, we know that they are currently projecting for capex spend of between $195 billion to $205 billion, and for that to expand significantly in 2027. However, they did not give us any details into what does significantly mean. So I think the only thing that I can get from that is that the AI investment cycle is actually still underway. It is not slowing down anytime soon, which means that I would think we start to see a slowdown maybe only after 2028. It really depends on how fast AI is going to develop. I think 18 months, a lot of things can happen. So I'm not too worried about the AI cycle. I think Lawrence pointed out a very nuanced point over here, that you have to understand that a lot of this might be circular financing. So there are its risk, and I was talking in the chat during the call, and I was saying that I feel like the chances of a hyperscaler like Google pulling back on capital expenditure is actually rather low. I think what is likely to be, if I were to place my money on it, what I think is likely going to be a catalyst for the AI sell-off, or for this bubble to really start to pop, is when you got a company like OpenAI or Anthropic, who are not able to generate the kind of revenues and profitability that they need in order to fulfill their end of the deals. And then you're going to start to see companies with huge remaining performance obligations take a hit. So I don't know if you guys have heard Steve's argument recently around RPOs. I think people were talking about how Oracle's RPOs are majority made up by OpenAI. And the fact that it is majority made up by OpenAI, it is concerning itself. Although on a absolute number basis, I know the argument that Steve tends to make is that even if you assume that OpenAI's contribution goes away entirely, they are still over $300 billion in contribution. That argument itself it doesn't hide the fact that the stock price was still greater without that revenue, because the stock price is where it is right now. I mean, okay, Oracle, granted, I know it's been taken down pretty badly, but for a lot of these companies out there, they are where they are because of the expectations of future growth based on their backlog. If you halve that backlog, the expectation for future growth halves as well. And so I think it can go down even further. So for me, I Oracle is a no touch for me, purely because they are dependent on OpenAI. CoreWeave, on the other hand, slightly different case. CoreWeave does have a customer concentration problem when it comes to Microsoft, but you are talking about Microsoft, not OpenAI. So there is a big difference over there. And CoreWeave's concentration, I believe, is only 30% compared to OpenAI, which is 50%. And CoreWeave does have the kind of agreements where they either pay up front, if they are not using their entire facility. Otherwise, they just have to take the facility and use it, which I think, it makes sense for a lot of these hyperscalers, that there's so much compute that is needed that I do think they will continue to expand their partnership with CoreWeave. So that is my take around the CapEx story. I don't think the slowdown will come because the hyperscalers choose to slow down. I think something must be the catalyst for hyperscalers to slow down, and that is likely one of the frontier labs not being able to fulfill their end of the contracts. Now, jumping in very quickly, I just want to take a look at the results of ServiceNow, because ServiceNow posted pretty strong results. Give me a minute. Let me see, where's the... all right, I'm going to use what I posted on X basically for this. Let me see. All right, so with so based on the three companies that we have seen, I think OpenAI, ServiceNow actually did the best. We are up 5% after the call. I did not listen to the call, so I have no idea what happened over there. But we are seeing some of the hardware names. Okay, NVIDIA was up a little bit more earlier on. But we are seeing Marvell up. I think that's natural with what they said about their TPUs. We also see Nebius CoreWeave up. Nebius up 2.5%. CoreWeave up nearly 2%. Iran up around 0.5%. I guess that is in reaction to Google saying that they're still compute constrained, and that expenditure is CapEx is still going to rise going into 2027. Now, when it comes to ServiceNow, I think they had a pretty strong quarter. Let me just pull up the results. So ServiceNow over here, where are they? Here, right? Have I filled up everything? Okay, so the thing about ServiceNow, and for some of these companies like Google, when you look at the results, it seems quite ridiculous upfront because of how big the margins are. But like for Google's case, there's a lot of unrealized gains. Oh, I just realized my camera is flat. So I've been on for 3 hours and I forgot to charge my camera after the morning stream. So there's that. So if it dies, just letting you know. So I'll get what I need to say out of the way, and then I'll talk more about it on stream on Friday. Or maybe I might stream tonight on Thursday as well. Bonus stream. But Okay, so for ServiceNow, what I like, number one, performance obligations grew 21% to $29 billion. Okay, so it shows that number one, ServiceNow is not like IBM, it is not like Pegasystems, where their software can be easily replaced. Like I've said just before they release their earnings, they are the orchestration layer. People are going to use agents. If they are going to use agents to replace things like Pegasystems, they are going to need ServiceNow in order for the agents to communicate with each other within the enterprise. So you have to understand the nuance between what each of the software does. You don't just take software as a broad stroke and then say that, oh, you know what, software is taking a hit. There are gems in the dirt, as some people say, right? So net income around $298 and free cash flow $473. A lot of this has are being affected by some of the ways that they some of the, what do you call it, gain on investments, correct? Some of the gain on investments, and there is $161 million at back of deal cost in free cash flow, which I have to go and really take a look. Like I said, ServiceNow has been is a current trade for me, at least to 150s or so in that range. So I can't say that I am the most like well-versed in its entire business model, but this is what I have so far. All right, so I will take a deeper look at the company, but I think they have done pretty well. As in, all the key metrics that I'm looking at are trending in the right direction. So I have no worry around ServiceNow. I think what I wanted to see is revenue growth, remaining performance obligations growth, and for management's commentary around future guidance. I think they did not really increase their full year guidance by that much, but they did outperform their own expectations. Because if you take a look over here, this basically shows you, where is it? Okay, this basically shows you their comparison to previously issued guidance. So right now, what they actually have is the Q2 performance over here is actually nearly 55 million more than what they actually projected previous guidance, the midpoint of their guidance. Similarly, for full year 2026, guidance is 15.75. They're on track to do 15.77, slightly more. And I expect this to accelerate as we go through the quarters, perhaps coming in closer to $16 billion. Now, with $29 billion of backlog, I think this is extremely bullish. They can, even if they realize around 50% of the remaining performance obligations, that's an easy double in terms of their revenue. Even if they maintain the kind of margins that they're doing now, the stock can very easily double from here, depending on the kind of multiple that you are assigning to it. So I really have no worry over here. In terms of Tesla, again, I follow Tesla on a quarterly basis. I am not as closely in tune with Tesla as I am with some of the hyperscalers like Google and Amazon. So I think my focus really for Tesla is on their delivery, is on the narrative around the company, right? And I think they're on track to deliver a lot of things. But as with Elon, you know, the things that he say, the kind of timeline that he gives to us, really, I think to me it's really more of a show me. So and I think there's nothing much to say about it. I think right now it does deserve to be down 2 to 3%, purely because of the kind of margin compression that we are seeing with Tesla. But that doesn't mean that it should stay down at these prices. If they do deliver on the things that they have promised, robo-taxis and all that, and as well as Optimus. I think I heard him say Optimus is in production in don't know which factory. So I am actually quite bullish on Tesla. At 358, it is still, I don't know. I find it very hard to pull the trigger on Tesla. At 343 times PE, I would much rather buy Palantir than Tesla at this point. So yeah, because and that was not always the case. I mean, there was a period of time when Palantir was more expensive than Tesla, But right now, like at these prices, I would much rather like the only reason why I'm not buying Tesla is because I feel like there are better deals out there right now. Service now is back up to $100 after their call. So let's hope that this momentum goes into market open tomorrow. All right, and with that, my camera is really flashing. So thank you for spending the last nearly 3 hours with me. I will be on for most of the major earnings call. I don't know whether you consider Intel major. I do not. Yeah, so I will not be on for Intel's earnings call, but I will be on a little bit longer, I guess, on Friday to break down some of the earnings that happened. American Express, we want to see that, and Intel as well. And so with that, thank you for your time. I will be releasing videos on some of these companies in the next couple of days. So I'm trying to diversify away from just BMNR and SoFi. Recently released a Robinhood video. So kind of like, yeah. So trying to broaden out my YouTube algorithm reach so that the algorithm recognizes me as more than just SoFi and BMNR. So I will be talking a little bit about Google and Tesla in separate videos over the next couple of days. But expect a BMNR video tonight, and then next week it's going to be CoreWeave, Zeta, Grab. All right. All right. Thank you for your time. Enjoyed talking to you guys on stream, and I will see you same time, same place on Friday.